Hey everyone, welcome back to Corporate Decoder, the place where we unpack the financial mysteries that shape our world, and sometimes it looks like we're trading rights to movie adaptations. Today we're diving into a recent filing from Asset Entities Inc. And let's just say things got interesting real fast with a movie rights deal that's been reassigned. Stick around because this story has some surprising twists and turns involving company insiders. So Asset Entities Inc. is a company that we've seen file these current reports basically telling everyone what's happening right now. They're based in Nevada and this report is about some significant changes afoot. The company's name itself, Asset Entities Inc., gives you a hint that they're involved in owning and managing various assets. This particular filing is dated August 18, 2025 and points to a deal that changes hands. Now here's something that might catch your eye. The company has Class B common stock trading on the Nasdaq stock market under the symbol SST. This tells us they are a publicly traded company and people can buy and sell shares of their business. They're also identifying themselves as an emerging growth company. This means they're a newer company and can follow some less strict reporting rules compared to the really big established players. This often means they might have less financial history for us to compare against, but they're growing and trying to make their mark. The main event in this report revolves around something pretty significant called a material definitive agreement. Essentially, this is a big official contract that can really change the company's direction. Back in November of the previous year, Asset Entities Inc. agreed to buy rights for a film, TV streaming and other media adaptations of a literary work. This work is titled One Step Closer, From Zero to Number One, Becoming Linkin Park. The deal was for $120,000 plus an extra $40,000 plus an extra $40,000 plus an extra $40,000 if they create a screenplay with payments tied to reaching certain goals. That initial agreement was disclosed in a previous filing. Now here's where the plot thickens. On August 18, 2025, Asset Entities Inc. entered into a new agreement called an Assignment and Assumption Agreement. Through this, they are basically transferring all their rights and responsibilities for that original deal to a different company called Hybrid Assets LLC. So why do this? In exchange for Asset Entities Inc. giving up its stake in the film rights, Hybrid Assets LLC is taking over all the company's duties and obligations related to that original purchase agreement. It's like handing over a contract with all its associated work and money. And importantly, Hybrid Assets LLC is also making sure Asset Entities Inc. is let go from any sort of backup responsibility for that deal. This means Asset Entities Inc. is stepping away cleanly from those original film rights obligations. But here's the kicker. As a reward for Asset Entities Inc. agreeing to transfer these rights, Hybrid Assets LLC is actually paying Asset Entities Inc. $200,000. This side deal is laid out in a separate letter agreement, so they're not just walking away, they're getting paid to exit this particular deal. This is where it gets even more interesting from a corporate governance perspective. Hybrid Assets LLC, the company taking over the film rights and paying the assignment fee, is managed by Michael Gobbard, who is the executive chairman and a director at Asset Entities Inc., and Matthew Kruger, who is the chief financial officer, treasurer, and secretary at Asset Entities Inc. And remember, Jeff Blue, the original seller of these rights. He's the head of entertainment for Asset Entities Inc. This means key people within Asset Entities Inc. are directly involved on both sides of this assignment transaction. The filing tells us that the descriptions of these agreements are just summaries and the actual full details are in the agreements themselves filed as exhibits. This is standard practice to keep the main filing concise. Then we get to the exhibit section, which basically lists all the supporting documents for this report. Here it confirms the assignment and assumption agreement and the letter agreement, which are the core of this report, are included as exhibits. These are the official documents proving the transfer of rights and the payment of the assignment fee. Finally, the report is signed off on August 20, 2025, confirming the company is officially documenting these events. The signature is by Arsha Sarkani, the Chief Executive Officer and President. Now let's look at the bigger picture here. Asset Entities Inc. bought into film rights for a significant amount of money. They then turn around and assign these rights to another company whose management overlaps directly with Asset Entities leadership. While they're getting $200,000 for this assignment, it seems like a strategic move to offload an asset or perhaps a way to streamline operations by having key management involved in entities that hold specific assets. The fact that the company's own executive chairman, CFO, and head of entertainment are involved with Hybrid Assets LLC raises questions about potential conflicts of interest, or at least a very interconnected business structure. Are they diversifying their own interests? Are they moving this asset to an entity better suited to manage it or develop it? The $200,000 fee shows that Asset Entities Inc. is being compensated for this transfer, but the immediate outcome for the company itself regarding the film rights isn't entirely clear from this filing alone. It looks like they are essentially selling these rights internally for a profit and removing them from their direct balance sheet. What's particularly interesting here is the company's overall direction. They're listed as emerging growth. This kind of deal could be a way for them to manage their cash flow and focus their resources. Instead of developing this film property themselves, they're facilitating its transfer and profiting from it up front. This aligns with the strategy of being an asset facilitator perhaps rather than a direct developer in this instance. The key risk here is transparency and how these related party transactions are viewed by investors and regulators. While $200,000 is a nice immediate cash inflow for Asset Entities Inc., the long-term implications of these internal dealings need to be watched closely. Are they developing a portfolio of assets and then moving them to specialized entities? Or is this a way to extract value before a project perhaps doesn't pan out as expected? My assessment of Asset Entities Inc. based on this filing is that they are a company actively managing its asset portfolio, perhaps with a more agile structure. The strength is their ability to make quick strategic moves and generate immediate cash from asset transfers. The weakness, or at least a point of caution, is the significant involvement of internal leadership in the entity receiving the assigned rights, which necessitates a close eye on their disclosures and financial reporting going forward. The opportunity lies in their potential to pivot quickly and capitalize on various asset types. The risk is that these intricate dealings could obscure the true underlying performance of the company if not managed with the utmost transparency. So what's your take on these internal deal makings at Asset Entities Inc.? Does this look like smart business or something to be wary of? Let me know your thoughts in the comments below. If you found this breakdown helpful, give this video a thumbs up and subscribe for more deep dives into the world of corporate finance. And don't forget to join our Discord community for more discussions and exclusive content linked in the description. Thanks for watching and we'll see you in the next one.